Hold on to your hats, folks, because the stock market is taking a nosedive. We're seeing a sea of red across the board, with major indices like the Dow Jones, S&P 500, and Nasdaq all plummeting. This isn't just a blip, people, it's a full-blown sell-off. The Dow is down over 500 points, the S&P 500 has shed nearly 3%, and the tech-heavy Nasdaq is leading the plunge with a whopping 4% decline. This is serious stuff, and it's got investors running for cover. It's a stark reminder that what goes up can most definitely come down, sometimes faster than you can say sell.
Path to profitability.
The pain isn't limited to Wall Street. This is a global sell-off, with stock markets around the world feeling the heat. Take Japan's Nikkei 225, for example. It's down over 2%, mirroring the losses we're seeing in the US. Japan's economy is heavily reliant on exports, and the strong yen, coupled with slowing global growth, is putting pressure on Japanese corporations. This, in turn, is weighing on the Nikkei, as investors fret about the impact on corporate profits. But it's not just Japan. European markets are also deep in the red, with the German DAX and the French CAC 40 both down over 3%. The Eurozone is facing its own set of challenges, including the ongoing war in Ukraine, an energy crisis, and rising inflation. These factors are all contributing to the gloomy mood in European markets.
What we're witnessing is a classic case of contagion. When one major market sneezes, the rest of the world catches a cold. The US stock market is the world's largest and most influential, so when it sells off, it sends shockwaves across the globe. Investors everywhere are in risk-off mode, dumping stocks and seeking refuge in safe haven assets like gold and government bonds. This interconnectedness is both a blessing and a curse. It allows for the free flow of capital and ideas, but it also means that trouble in one corner of the world can quickly spread to others. In today's globalized economy, no market is an island. The sell-off is a stark reminder that we live in a volatile and uncertain world. Investors need to be prepared for sudden shifts in sentiment and be ready to adjust their portfolios accordingly. Diversification is key, as is a long-term perspective.
Section 5. Unmasking the bear, geopolitics and economic jitters. What's at the root of this global market slump? It's like a bad detective novel with multiple suspects. First, geopolitics, always a market mover. The conflict in Ukraine disrupts supply chains and fuels inflation. Then, US-China tensions, a trade war that's far from over. Economic anxieties weigh heavily on investors' minds. Inflation is persistent, forcing central banks to act. The Federal Reserve is raising interest rates aggressively. The Fed's stance has investors worried about a recession. Section 6. Expert opinions navigating the stormy market. With the market in freefall, everyone's looking for answers. Who better to turn to than the experts? We've got analysts, economists, and market gurus all weighing in on what's next for the global economy and, more importantly, your money. Some are urging calm, reminding us that market corrections are a natural part of the economic cycle. They argue that this pullback is healthy, a necessary adjustment after years of exuberance. They point to strong corporate earnings and a robust labor market as signs that the underlying economy is still in good shape. Others, however, are more cautious, warning that this could be the beginning of a more protracted downturn. They cite the Fed's aggressive tightening, persistent inflation, and the ongoing war in Ukraine as major risks to the outlook. They advise investors to batten down the hatches and prepare for a bumpy ride. So who's right? Honestly, nobody knows for sure. The market is a complex beast driven by a multitude of factors, many of which are impossible to predict.
Section 7. Investor Anxiety Strategies for Uncertain Times. It's perfectly natural to feel anxious when the market takes a tumble. After all, it's your hard-earned money on the line. But panicking is the worst thing you can do. Now's the time to take a deep breath, assess your portfolio, and make sure your investment strategy is still aligned with your goals. If you're a long-term investor, this market dip could actually present a buying opportunity. Remember, the best time to buy is when there's blood in the streets, even if it's your own. However, it's crucial to be selective. Focus on companies with strong fundamentals, solid balance sheets, and a history of profitability. Avoid chasing after the latest fads or trying to time the market. That's a fool's errand. If you're closer to retirement or have a lower risk tolerance, you might consider rebalancing your portfolio to reduce your exposure to equities. This could involve shifting some of your assets into more conservative investments like bonds or cash.
Section 8. Weathering the storm long-term perspective. The key to navigating market turmoil is to maintain a long-term perspective. The stock market is a roller coaster with its share of ups and downs, but over the long haul, it has always trended upwards. Remember, this isn't the first time the market has faced challenges, and it won't be the last. We've been through wars, recessions, pandemics, and countless other crises, and yet the market has always bounced back, stronger than before. So don't panic. Stick to your investment plan, stay informed, and remember that this too shall pass. The market may be down today, but it won't stay down forever.
Section 9. The Tech Conundrum. Re-evaluating growth prospects. The tech sector, once considered invincible, is facing a reckoning. As interest rates rise and inflation persists, investors are re-evaluating the growth prospects of tech companies, particularly those that are not yet profitable. The era of easy money is over, and tech companies that have relied on cheap capital to fuel their growth are now feeling the pinch. Investors are no longer willing to pay exorbitant valuations for companies that are not generating profits. This doesn't mean that the tech sector is doomed, far from it. But it does mean that the days of unbridled growth and sky-high valuations are over. Investors are becoming more discerning, focusing on companies with strong fundamentals, a clear path to profitability, and a competitive edge in the marketplace.
Section 10. Global Outlook. A Synchronized Slowdown. The global economy is facing a confluence of challenges, from the war in Ukraine to rising inflation and slowing growth. The International Monetary Fund, IMF, has downgraded its global growth forecast for 2023, warning of a synchronized slowdown in major economies. The IMF points to several factors contributing to the gloomy outlook, including the ongoing war in Ukraine, tightening financial conditions, and persistent supply chain disruptions. The organization warns that the risks to the global economic outlook are overwhelmingly tilted to the downside. The synchronized slowdown has raised concerns about a potential global recession. While a recession is not the IMF's baseline scenario, the organization acknowledges that the risks are elevated.
Section 11. Market Turmoil, a wake-up call. The recent market turmoil serves as a stark reminder that investing in the stock market always carries risks. While the market has historically trended upwards over the long term, it is prone to periods of volatility and decline. Investors need to be prepared for these inevitable downturns and have a plan in place to navigate them. This includes having a well-diversified portfolio, maintaining a long-term perspective, and avoiding emotional decision-making. The current market sell-off may also be a wake-up call for investors who have become complacent after years of strong market returns. It's essential to remember that past performance is not indicative of future results, and that the market can change direction quickly and unexpectedly.